Good evening, ladies and gentlemen, and welcome to our webinar on trading the news. Tonight's webinar is sponsored by ADS Prime. ADS is one of the leading Forex and CFD providers in the world, and they are our sponsor for tonight. They are regulated in many districts, regions, and countries around the globe, and they offer unequal service, support, education, and all types of trading and trading orders. They hold licenses in the FCA. They have a license in Dubai. They have licenses throughout the Middle East, as well as in London and all of Europe. So you'll know you'll be trading with one of the best regulated providers. They offer trading in indices, currencies, commodities, shares, metals, and treasury bonds, which is a broader range than most of the providers in the marketplace. So let's get started with our class on trading the news. Now, trading the news can be very profitable if you can correctly guess, and that is an important word, guess, which way price is going to move. Price can often move 30 or 40 pips very quickly on big news releases, but knowing which way it's going to move is very much a gamble. So most traders do not trade the news, as it's just too risky, and you often get stopped out as price moves one way and then the other. Most traders have experienced this whipsaw effect when price goes up and down very quickly. So it seems that no matter which way you trade, you can always get stopped out. Now, we mix up the word news, or the word headline, or the word event, or economic event, because every economic event is considered news. Every central bank speaker, every central bank action is considered news. Now, it's very, very hard to trade like elections. It's very, very difficult to trade Brexit votes. It's very difficult to trade a speech from Donald Trump or from Theresa May, because it's very hard to judge these, and we don't know what they're going to say, how long their speech is going to happen, what they're going to tweak, and we also, in most cases, don't know when they're even going to say something. So all of a sudden, we'll see a public headline, and then the question is, when Donald Trump does something and tweets something in the middle of the night, how long does it take you to get it? So trading the news on headline events happening in the newspaper, especially today, with everything being online and being reprinted and reprinted and reprinted, you could be reading something that just popped up on the internet, but it happened 6 hours ago, but CNN's just getting around to releasing it. Okay. So running down and trying to be the first to get it, like 2 years ago when Russia invaded the Ukraine, well, if you were able to get that news first, and it happened on a weekend, so we were all pretty much safe until the Monday trading, but you could have analyzed right away that what was going to happen. Gold was going to go up, price of oil was going to go through the ceiling, markets were going to go to risk-off mode, and we could have seen the Japanese yen jump. Every time North Korea fires a rocket off lately, we would see it's because the markets got used to it, but we saw jumps in gold. But it wasn't a crisis. It wasn't, it is a crisis, but it wasn't a financial crisis. When we saw all the Mideastern countries do the stuff what they did with Kuwait a month ago, yes, the local markets reacted, but we didn't see anything in the financial markets. Okay. So trading these kind of news events is difficult, to say the least. But there's other kind of news events. For instance, every time Mario Draghi is going to speak from the ECB, it's scheduled way ahead of time. We know exactly when he's going to reach the podium because he knows exactly what words he's going to say and how it's going to affect the markets. So they don't dilly-dally around. He picks and chooses his words very carefully. Even when a president of one of the main banks in the U.S. speaks, one of the Federal Reserve presidents, they pick their words very carefully. They pick their topics. They pick their name of their speech, which is printed ahead of time, very carefully. And they are very careful in the wording. So because, again, we know the markets will react. So what do we have coming up now is a major news event. We have Jackson Hole. And this year, the markets are all anticipating Mario Draghi, who's making one of the keynote speeches, to discuss QA and the tapering of the QA policy to preempt their September meeting, which happens about a week after the Jackson Hole meeting. So sometimes we can prepare for those kind of news events. A G20 or G8 summit is on the calendar. We don't know what they're going to say, but we know about when it's going to affect the markets. But then we have economic events. And when an economic release comes out, markets can react very violently as traders enter and exit positions based on new information. Some news releases are more important than others. And this is one of the things you have to learn. Which events will affect the markets the most, and when and why they'll affect the markets. It's like most of the events on the calendar this month, over the next 2 weeks, outside of Jackson Hole, it's going to have very little effect on the markets. Why? Well, this is major vacation season. Most of our senior political figures are on holiday, so they're not making much comments. Most of our bigger traders or hedge fund managers are planning their holidays, so they're removing themselves from the markets for a short while. And then you have huge amounts of people on vacation. So we have, unless something really freaky happens, where we don't have that many major economic events, and because volume is low, the markets don't react the same. Now, there's also times that the other side of the coin is when everybody's there to trade, but there's really nothing in the headlines and there's nothing on the economics calendar, that a small little freaky headline can send the markets off in volatility, only because traders are looking for a reason to trade. So we have to be very careful about our decisions to make. But economic events, because they are scheduled and planned, allow us to prepare for the trading. And all of these events all come back to one little circle. Because all of these events, whether it's the non-farm payroll report, inflation figures, it all affects how the central banks will act and react. And what we expect from the central banks then affect the value of our currency. Okay. And of course, when we do something in the U.S. that affects the value of the dollar, it has another effect on gold. Okay. When we have an effect on dollar, it has a weighs on crude oil, which is traded in dollars. It weighs on copper, which is traded in dollars. Economic events out of China have serious effect on not just the Chinese currency, but on its cross currencies like the Australian dollar and New Zealand dollar, but it also has a big effect on the price of copper. But the fact is, these days, we have all these sophisticated algorithms that process news releases in the blink of an eye and move markets accordingly. So the big hedge funds, the nice thing about it is we can get the data as fast as just about anybody else can, because it's all released from data feeds. But we can't react as fast. And these big hedge funds and these big financial houses, they react because their computers are set and designed to act and react, and the inconsistency or the imbalance in the market last very, very shortly. But even so, the biggest news releases can create opportunities in the market because they cause long-lasting price moves and momentarily distort the efficiency of the markets. Now, remember, the economics calendar is a fundamental tool for traders to position themselves to take advantage of future currency movements or other assets. The economics calendar is published daily and is the main trading tool for traders using fundamental analysis as entry and exit signals. Now, the other thing to keep in mind also is trading the news or trading the economic events only can give you entry and exit points. Okay. Yes, a good GDP reprint out of the U.S. will send the U.S. dollar up, but it's also going to have an effect on the stock markets, and not everybody wants to trade these instantaneous responses, because that gets really difficult unless you know exactly what you're doing. But it's going to have a longer term effect on the dollar. Okay. So you might want to take a longer position and not get involved in the craziness of the markets. Okay. But the fact is, no fundamental news, no economic data release is going to tell you what the true value of the U.S. dollar should be. It'll give you an entry. It'll give you a trade. It'll say, okay, this is a good trade, or get out of the market now. But it's not going to tell you how far it should rise. It's not going to tell you where to put your stop losses. It's not going to tell you where to put your take profit points. Now, believe it or not, there are a large number of amateur traders who ignore news events and economic releases completely. They concentrate solely on technical indicators and chart patterns. And they wonder why the market spiked violently against them in the space of a couple minutes. Now, whether you are a technical trader, no matter what strategy you're using, to ignore economic events, whether it's a speech or a data release, because it can cause very short-term volatility. And even though the event may come out as expected, or Mario Draghi may say exactly what the public is expecting, it can cause that euro to spike up and down, up and down, up and down during his speech. Now, the fact is, you don't care about Mario Draghi's speech because what are you doing? You're trading based on technical indicators, and you've entered the euro to go up because all your indicators told you it should go up, and you've estimated it should go from 117 to 118. You put your stop loss at 116.50 based on your risk margin, risk and reward ratio, and your risk management strategies. But the fact is, Mario Draghi's speech could send that euro down just for a second or two, and you can get stopped out. Your trade could have been completely right, but if you can't take in, if you're not aware that there's going to be a volatile surge or a possibility for volatility that's going to be outside the normal range, you could end up losing a very good trade that you did all the right decisions on, only because something spiked it in the middle of your trading window. Now, other traders acknowledge the importance of news releases, but they see them as unpredictable and too risky to trade. For the most part, they have been taught to trade during quiet market hours and always to be flat whenever a news release is coming out. In truth, there is nothing wrong with this approach. News releases are certainly unpredictable, and they can turn your winning trades into losing if you're not careful. But there are ways that you can trade these events. There are strategies that you can employ. First of all, economic events tend to be one of the most important catalysts for short-term movement in any market. But this is particularly true in the currency market, which responds not only to U.S. economic data, but to other news from around the world. Now, the thing that you have to first concentrate on is what events, what headlines, what assets will be affected by these news events. Okay. Like I said, when Russia invaded Ukraine 2 years ago, who would have thought, what assets would you have affected? Well, a novice trader would have immediately gone, well, gold should go up and the dollar should go down, the yen should spike because of risk. But they avoided oil. Didn't stop to think, well, Russia's a major exporter of crude oil. Lots of gas goes through the Ukraine. All of a sudden, that's going to spike the biggest. Oil was trading, I believe, at $86 at the market close on Friday. By Monday, as soon as it opened, it soared to $106. That was a $20 guaranteed rise. You could have entered that market first thing Monday morning and rode oil up, straight up. Well, that would have been a very easy news trade. So trading news is harder than it may sound. Not only is the reported consensus figure, but so are the whispered numbers and the revisions. Now, we all have to be aware of understanding and trading these events. Now, in this class, we're not here to learn how to read an economics calendar. We have whole other classes in reading the economics calendar. Here, we're going to assume that you know how to use your economics calendar properly. If you don't, please come to our class, one of our classes called Trading the Economics Calendar, and we'll teach you what these revisions and these whispered numbers are. We'll teach you what the consensus is, what the previous is, what the revisions could be, and how to properly read these reports. But first off, markets move a lot more in line with what the expectations are for an upcoming economic news release rather than what the actual news release is. Meaning, because traders trade their beliefs about upcoming events, often when the actual event or the news release happens, the move is either over or ready to come roaring back in the opposite direction. Because remember, most traders are taking positions ahead of whether it's a speech from Mr. Draghi, a speech from Janet Yellen, whether it's a G20 meeting, or whether it's just a report on jobs. Traders are taking position ahead of time. So a lot of times you can see well ahead of time what the markets are expecting, because you can see the assets that would be affected by that trade moving in those directions. So even though the report actually comes out and it's exactly what it's thought to be, or Mario Draghi comes out after the rate meeting and holds rates and does exactly what the market expected, well, on the surface, that says the market shouldn't have any reaction, correct? But it does, because everybody was expecting him to say or do something different. So for instance, when we had the last rate increase from the U.S., everybody, the Feds had telegraphed it out to everybody. Everybody had taken position. It technically wouldn't have had any effect on the marketplace. And this is exactly what the Feds want. They don't want to cause volatility. But when they actually mention the balance sheet and normalizing monetary policy and selling out of some of their balance sheet, which wasn't expected to be mentioned in their notes, they didn't take any action. It's just when they start mentioning it in their conversation, when the markets weren't expecting that to be part of their conversation till September, you got a very positive reaction, more so than what the markets were expecting, because otherwise we had the half a point rate increase just like was predicted. Now, the first thing one has to do is understand all the major effects on the exchange rates and what assets will be affected, and how all of these events go into one great big circle, and how one will affect another. Because I've seen many traders make serious mistakes. Okay, just a year ago, a year and a half ago, before the Fed started raising their rates, everybody was wondering when the Feds would start their policy of returning, raising the rates from, all the way down about zero. And everybody was watching the non-farm payroll report, because they were expecting whenever this report came out and it was extremely good, that would push the Feds to raise rates. Now, a good jobs report normally is very supportive of the stock market. But a rate increase is not supportive of the stock market. So when we got a very high non-farm payroll report, people would have normally been jumping into the markets, because that's a very good sign on the economy. But because if you neglected to see that that was the push for the Feds to start raising their rates, okay, so it was interpreting these policies wrong. Or 2 years ago, when we got the December rate increase, and then we got a terrible, terrible jobs report. Gold went up, the dollar went down instantaneously. The volatility was absolutely incredible. But at 15 minutes later, the markets had reversed themselves. Why? Because even though the initial headline report was very, very weak, there was a huge revision to the prior month's jobs report, which didn't come out. It comes all out together, but that jobs report takes so long to release that the markets reacted to the number when we were expecting 200,000 jobs and we got like 139,000. But we had a 60,000 job revision upward to the prior month. So the net result was extremely positive, but the markets had already reacted. So you have to understand what to do and how to read these events and how they all tied together. So changes in market inflation cause changes in currency exchange. A country with a lower inflation rate than another's will see the appreciation in the value of its currency. The price of goods and services increase at a slower rate where inflation is low. A country with a consistently low inflation rate exhibits a rising currency value, while a country with higher inflation typically sees depreciation. Except when we're coming out of a situation where inflation was non-existent and we're actually trying to see inflation bounce back towards the 2% level around the globe. Once we get somewhere around that, this rule will hold true. But right now, we need to, so right now, what's Japan got? They got quantitative easing, which is pushing up the value of the currency or depreciating the value of the currency, but they have virtually no inflation. They have deflation, which is on the other side of that report. But why does it all change together? Because inflation has an effect on interest rates, because the central banks control inflation by increasing interest rates. So when inflation goes up, we would expect the central bank to act. So changes of interest rates affect currency values and dollar exchange rate. Forex rates, interest rates, and inflation are all correlated. Increases in interest rates cause a country's currency to appreciate because higher interest rates provide higher rates to lenders, thereby attracting more foreign capital, which causes a rise in the exchange rate. And this is what a lot of people don't see and understand this. It's how all of these factors fold together, because a higher interest rate means companies, corporations that have huge debt, not out of proportion, but if you're a big company and you have $1 million in debt, even though you have lots of assets, well, a 25 basis point increase in rate has a direct effect on your profitability, because if you got $1 million in debt, well, you know what? That's $25,000 more in interest you're going to have to pay. But on the other hand, a higher rate brings in foreign capital. Foreign capital pushes the wheel and helps all of our investments. Then we have the country's current account or balance of payments. Government debt is ultimately important because, again, government debt gets too high. What happens is the foreign investors stop investing or stop buying government debt, and that means it drives up the price of our treasury bonds or the country's bonds in the public market, and therefore the countries have to pay higher interest rates. So when an event comes out, the first thing we have to do is we have to be able to analyze the markets. We have to determine what assets will be affected, what range based on the whispered numbers and the consensus will be market negative and market positive for those assets. But then there's many ways that we can actually trade these results. But before we can trade the results, we have to understand what these implications are. once we understand the implications, we can start making trading decisions. So the most common way to trade news is to look for a periodic consolidation ahead of the big number, or to just trade the breakout on the back of the number. This can be done on a short-term intraday basis or a daily basis. So we can see the initial consolidation ahead of an event and then the knee-jerk reaction, but this becomes a very difficult way to trade because you can't predict anything, and it's almost like betting or gambling, okay? Because the markets move so erratically and so violently that it's hard to set stop losses, take profit points, to use any determination of where that asset should bounce to and how fast, because you can see them zigzag up, zigzag up. But a lot of traders do that because there are ways in which you can enter these trades, use specific type orders that you can trade on both sides of these events. And we'll talk about that in a second. But remember, the markets will make, if the event is outside of what we call market neutral, you're going to have a volatile market. But even when it's market neutral, meaning it comes out where it's expected, you can judge where the traders had pushed it ahead of time, and will the traders have to cause some reaction to get it back to where it should have been, or neutral side. Okay. So trading the news can be very profitable if you can correctly guess which way price is going. Price can often move 30 or 40 pips in either direction. Okay. So the first thing we have to do is we have to determine what is market neutral, finding what would be market positive and what would be market negative, and what assets would be affected by each one of these ranges and how. This allows you can do this way ahead of time because the market expectations or the forecast are out a week ahead of time. So you can sit down and do all of your analysis, do all of your interpretation, what assets you would want to trade, where you would want to see these assets, because you don't have to worry about where the dollar is going to be at Tuesday, that event. If you say if this event is in this market positive territory, it's going to send the dollar down and the euro up. You don't care where it's sitting at that moment because you know it's going, because you're trading momentum as opposed to price. So this is just the first thing you're considering, and you can consider this way ahead of time. You can also determine if you want to do long-term trades. Will this, and these are the easier ones, and probably, if you have a lower risk management policy and you're using good money management skills, this is probably the best way to do it, is determine what will the longer term effect be. And we're not talking about long-term effect more than the next 2 days, but be on that asset. Now, short-term, to trade the news on a short-term basis, a trader must have a clear criterion of what kind of news they will justify a trade. Many traders seek at least a 50% surprise in the data to consider a news release tradable. A novice trader, in turn, can use the initial period of his trading career by perfecting his money management skills. Trading the news on a short-term basis can be easy and lucrative if the trader is disciplined enough to cut losses and accumulate profit, and eliminate panic and mood swings. An undisciplined methodology will quickly erase all the gains through shocks and volatility. Now, the first thing we want to do to set a nice strategy for trading is approximately 30 minutes before an announcement, a trader can plot support and resistance based on price action. We can start putting our support and resistance on our asset charts because remember, ahead of time, we've already determined what assets will be affected by the event. We've got our charts ready. So about a half hour before, we can look at where price is, what our next support and resistance levels will be. Okay. And this can be done by observing the past few hours immediately prior to the release and drawing a rectangle from the high and the low that was hit during that period. This can be done on a 5-minute, 15-minute, even a 1-minute chart. And all we're trying to determine is the range in which that asset is bouncing around. If looking for maximum movement, often one of the major currency pairs, like with the US dollar, will suit that need. If looking for a more conservative approach, cross pairs can certainly work as well. That's pairs without the US dollar. So if you're looking for a major event and it's coming out of the US, a more conservative approach could be to trade another pair of assets that will be affected by that event that don't include the US dollar. Or the same thing as something coming out of the UK. You might say, fine, this would be very positive for the pound, and it might be supportive of the euro. And so therefore, I'm going to trade the euro against the dollar, not the pound, because I want something a little bit more conservative. But you will need to determine the assets that will be affected by the release. Now, the reason for this can be numerous, but the key among them is the fact that liquidity providers and market makers that set the prices for which we execute our trades are cautious. They fully realize that a surprising number can spark a rally or a sell-off in a very short period of time. And leading into the announcement, any significant positions taken on can bear significant risk to the liquidity providers. So once we've identified the assets, we've identified our support and resistance levels, now we want to come to something interesting. And this is one of the ways that we can build a strategy. And this is called set entry orders. And there are many ways that you can set different orders. And you have to determine ahead of time what type of orders your broker accepts. And there are strategies where you can place two orders simultaneously for the euro to go up or to go down, and instruct your broker as first in, first out. In other words, the first order executed cancels the second order. So if you think the event's going to come out and send the euro skyrocketing, but you're not sure because it could send the euro going down because it'd be a miss, you can set a trade on the euro at either side and set an entry level and instruct the broker that if it initiates the up trade, it will cancel, not open the cancel trade. Or you could set two trades, one above and one below, and let both of them be executed. So while the markets are getting volatile, you take advantage of the market going up, and then when it comes back down, it automatically will execute your second trade. But now it's where would you put your stop losses and your take profit points. Okay, so now that you've plotted support and resistance based entirely around the price action taking place leading an announcement, we can begin to set our game plan. The one thing we know for certain going into a news announcement is there will probably be volatility. Predicting which direction that volatility may move is what makes trading news difficult. But we don't need to know the direction that volatility will push prices, as we can set entry orders on either side of the support and resistance lines. So in other words, hypothetically, say the euro is trading at 117. Our resistance level is at 117.12, and our support level is at 116.50. On either side. Okay. Now, we can put a buy order above the support level at whatever it was, 117.10, whatever I guesstimated, and a sell level below the 116.50. And if the market goes up, it'll execute the first order above the support, because we don't want to set it very close. We're going to set it at the resistance level, because if it breaks that resistance level, the volatility is pushing the asset to go up. So now we have two orders. We don't have two trades executed. We have two orders open on either side of the event. Now, what if the price comes down to open up at our short position and then moves directly back to our prior resistance to trigger us in a long position? Now, for traders in the United States, which none of us are, there is a first in, first out execution as standard. Okay. But we're not. So if you would like to have an entry order to go long to be canceled as soon as your short position is entered, you can set what's called one cancels the other. or an OCO order. Okay. And these are some of the reasons that traders need to learn how to use their platform. Too many traders just go in and buy, sell, buy, sell, buy, sell, and don't understand that there's all different kinds of orders that you can execute. There are all different kinds of stop losses you can continually moving. There's all kinds of strategies based on these executions that you can use that you don't have to actually be trading technicals. So if you would like the entry order to go long to be canceled as soon as the short position entered or vice versa, you can set the one cancels the other. That way, when the short position is entered into, the long entry gets canceled. This can be done very easily from the platform, and most every currency trading platform out there offers it. All other orders are entered. You can click on a tab Trading on the platform and choose orders followed by the complex OCO. Doing so will bring up the following box. Initially, all entry orders will show up in the top box, and we can simply highlight the orders we want to be part of. Now, if your platform doesn't offer this, you can set up two separate orders, because until the order is executed, you can cancel it. So you have it set up and ready to be triggered, and when the market moves up, it triggers that one, and you physically close the other one, but you have to be watching. We can simply highlight the order we want to put on the OCO by clicking on Select All for all available orders, and then follow the button to the top box and on to the left to add. Okay. But now we've got different types of orders. So we've decided what orders we want to set up. Now comes, how do you protect yourself from huge losses, huge moves against you? And we have to do that by stop loss or limit orders. Because we are anticipating volatility during a fast-moving environment, it benefits us to add proper risk management parameters to our trades. We have to keep in mind that the number one mistake Forex traders make is risking too much to make too little. So despite lofty winning percentages, this type of inverse risk-reward ratio doesn't allow for much long-term success. Traders are right more than 50% of the time, but lose money on losing trades more than they win on winning trades. Traders should use stop and limit orders to enforce a risk-reward ratio of at least 1 to 1 or higher. I use 1 to 3. Because we have identified support and resistance previously when setting our entry orders, we can look to place our stops on the other side of the range. So for the stop entry, looking to break the support, stops can be placed slightly above resistance, and for the long entry, hoping to break the resistance, stops can be placed below the support level. Also, profit targets or limits should be limited to 100% of that. If you are risking 50 pips on a trade idea, look for a minimum of 50 pips to make it sure worth it's your time. Many traders will actually look for much more than that number of pips risk. Seeking a much higher risk-reward ratio, such as a 1 to 3, 50 pips risk for 150 pips spot, or some will go 1 to 5. Okay. You have to determine and implement what your risk policy is. One thing you often hear news traders say is, I made the right call, but the market's moved in the wrong direction. So failed breakouts are very common around these events. New information may cause the market to move above or below key levels for a short time. But these moves often reverse and frustrate all the traders on the wrong side. Rapid whipsaw trade price activity also places the markets digest the new information. So what typically happens is the first group of traders, those who react when the seconds are released, often don't have the time to digest the information properly. As I was explaining to you about the non-farms payroll reports a couple years ago, or a couple months ago. We take it at face value in the hopes of beating the crowd and trade in the obvious direction. In other words, bad economic data means sell, good economic data means buy. But any new item of data has to be weighed up against the current economic backdrop and other interrelated factors. For example, positive economic news that the U.S. may send the dollar lower. Okay, this drives people crazy. The reason being is we're in a period of increased risk appetite. So a better macroeconomic outlook would indicate a flow of funds away from safe havens and reserves such as the US dollar. And this is very confusing to a lot of traders. When we get very supportive data out of the US, it might be very weak for the US dollar. Because when traders go to risk off mode or risk on mode, where do they go? They go to the stock market. So if we get sometimes extremely strong data, the dollar might still fall and you might see the stock market go up. So what happens is you're trading the euro US dollar for the euro to US dollar to go down, and it doesn't because the dollar doesn't strengthen because the stock market surges. Okay. There are many other situations where the market reaction is the reverse of the obvious and it just doesn't react at all. One reason is better forward guidance and communication by agencies such as central banks and government departments. Okay. Given the above complications, why even try to trade the events at all instead of trying to anticipate the market reaction? A more reliable approach for traders is to use a strategy which profits from volatility, basically movements of price in either direction. Okay. This works by setting up a grid that straddles the narrow trading channel that forms prior to the data release. After the event, the price generally breaks out of the channel in either direction and then whipsaws or trends until a new equilibrium is found. In doing so, the price crosses some of or all of the grid lines. Okay. So we can build this grid around our prices and have a continuous buy or sell scenario to take advantage. There are several grid configurations that work well for this scenario. I can't explain them all to you. There's tons of them out there, but you can look them up easily on the internet and figure out how to hedge and straddle using a grid scenario. And there you're just simply taking advantage of the volatility. So what you're looking for is you don't care whether an event's good or bad. You only care that the event's causing volatility, and you base it on your support and you're buying up and down, up and down, up and down on the volatility as opposed to the actual asset values. Basically, the rule of trading news events is this: if high volatility is expected, use a single down grid. Otherwise, use a single up grid. A single down grid is clear winner in high volatility situations. This is because it reaches a maximum profit potential when the price crosses the grids at all levels and all trades are executed. On the other hand, the other option is to run a two grids simultaneously to create a dual system. Okay, now, a grid is simply a set of boxes or a grid built around support and resistance levels on either side of the current value of the asset. Okay. The idea is when one system is profit, the other it's closed out, with the hopes that the market will reverse and push the other side of the grid into profit. And at least to give some overall net profit. So what you do is sometimes you have several trades going up and buy trades, and some you lose, some you win, but overall you will walk away with a net profit. This can be useful under certain conditions, but it needs a more complex trade management. Then we also have trading a directional bias. So let's stick with an unemployment rate example to keep it simple. The first thing you would want to do before the report comes out is to take a look at the trend of the unemployment rate to see where it's been increasing or decreasing. By looking at what has been happening in the past, you can prepare yourself for what might happen in the future. Okay. And then you can take advantage of the trend in the marketplace to set a directional bias. So you are expecting unemployment rates to rise. You can now start preparing to go short on the dollar. This would be your directional bias. Okay, so as you can see, there are many, many ways of trading or many strategies that you can successfully use. Order entries and order limits and stop losses and momentum trading are many ways to trade these economic and news events that many traders don't think about. But now the problem with trading news events is your stop losses. When most traders enter trades, they set a stop loss. The stop loss can be anything from 10 pips to 30 pips or more if you're trading higher time frames. Now, if you're trading news in that 15-minute time frame, you can set your stop loss, but how big should you put it? This is very important. But there's many ways you can think about this. If you think about what happens in a whipsaw, price moves up, stops out short traders, price moves down, stops out long traders. Now you know price is going to go up and down to stop out shorts, and you know it's going to go down to stop out longs. So how can you do this? You can enter two trades, one long and one short. So as you close as close as you can to the mid price of the price leads up in the whipsaw, and you can allow it to go up and down, and set your stop losses appropriately. Something else you consider to maximize your profit is to trade strategies on multiple pairs. If the news is dollar related, you can trade all the dollar pairs. If the euro is related, you can trade all the euro pairs. As long as you have a tight range you are looking at before the news releases, trade multiple pairs will also spread your risk. So remember, you start out by building your matrix: market neutral, market positive, market negative. Determine the assets that might be affected, the reasons why they might be affected, and then determine what you want to do. But you need to learn these strategies in great detail. You're not going to learn any of these strategies in one webinar. You're not going to learn any of these strategies in 1 hour or 1 day. But the first thing you have to do is, one of the best ones out there is mastering the order execution processes on your platform, to understand what features you have and how to use those features properly. Because that's not understanding assets and strategies. It's first understanding in detail what you can execute. And it may be that you need to move up to a MT4 platform, but that means you have to learn that MT4 platform. It means you have to make yourself a better trader, a more knowledgeable trader. Understand the tools you have to work with, and you'll find out that you can use those tools to make you a more successful trader. So have a very good night now. And if you want to sign up for a demo account with ADS, you'll have all those tools at your disposal. So have a very good night now, and thank you for joining us, and thank you for supporting investing.com and ADS Prime. Good day.